This is TreppWire Week in Review for week ending June 26th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. Each week, I'm joined with our experts, Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance this week. While states like New York reopen for business, other states like Florida, Arizona, and Texas take a pause due to the surge in COVID-19 cases. Weekly jobless claims slightly lower than last week at 1.48 million. However, they remain stubbornly above 1 million. The durable goods number was a surprise on the upside, jumping 15.8% last month. Wall Street shook off some of the bad news with the announcement that the FDIC was relaxing bank regulations known as Volcker. Manus and Joe, looking at some of the macro news, and there's plenty of it, is the glass half empty or full for you this week?
Well, I'll start off. I hate being this guy, but I'm always this guy. I'm the glass half empty guy. I've been doing it for several weeks. I have such faith in American ingenuity and the brightness of our future. So long term, I'm always so positive. But 2020 has been a slog when you get right down to it. And it's not just the COVID, right? It's everything. We got the murder hornets. We got the epic locust swarm in Africa.
This week, dust cloud on the way.
Huge sandstorm hitting us from the Sahara Desert this week. They told us last week that we got the Mayan calendar wrong, that the world's going to end this month. It wasn't really supposed to end 2 years ago, like when they first told us. We had read the tea leaves wrong. We had the Mr. Peanut hoax. Bill de Blasio is welding shut playgrounds. And now they're adding the DH to the National League. Like, how much can one guy take?
How dare they? I'm a little half empty this week, to be honest. So we might be on the negative side with our episode this week. I mean, I really didn't love seeing Texas pausing the reopening. I thought it was interesting. What I was reading is that they said if you've reopened already, you can stay open. But if you were about to reopen but you hadn't reopened yet, you can't reopen yet. I think. Who am I to say? I'm no Fauci, right? But I think that there is a little bit of alarmism in the reporting of new cases, because new cases don't necessarily mean, ICUs, hospital beds, deaths, and things like that. But I also find that it's very hard to even get a real answer on what's really going on and how really bad or not bad things actually are in these places. So, it's just a sign of the times in terms of what's available, in the media and on social media and everywhere else. It's very hard to know what's really going on. So maybe I'm just a little bit negative on that side, but I'm with Manus on the long term, as Buffett calls it, the American tailwind, right? We will be fine in the long term. I saw jobless claims came in at almost 1.5 million, which is similar to last week. So they're kind of leveling off, but saying that they're leveling off at 1.5 million is kind of scary, right? Because it used to be like, 20,000 or 100,000 or something like that. So 1.5 million new per week is pretty scary. We're getting a few more people flying. I would say anecdotally, there are a lot more people on the roads. I think we drove out to New Jersey yesterday, and there were tons of tractor trailers and people driving. So, that was good. I always like to see that. It's funny. New York is now, what are they, quarantining visitors from other places, which I think is kind of funny because we've been like the pariah state for the longest time. So things are turning around. So, I mean, I don't know. We will be fine, but there is a lot of weirdness going on in the world right now, which makes me feel a little negative.
I stopped looking at the data a long time ago, and I just decided that it's my own common sense that has to rule the day, right? You see the guy reading the newspaper who's licking his thumb every time he's turning the page, right? He's not the guy that you're going to go up and shake hands with, right? Or the mother who's wiping the schmutz off the kid's face with her, the nail of her thumb, right? Or the guy who's sneezing all over the place, right? Like, it's just common sense. And I think if we all just stop looking at the numbers and stop looking at the data and just apply some common sense, it's all going to be fine, right? It's just, we're scaring ourselves to death a little bit here at times. And I think that it's time to take a deep breath and understand that we've been in it now for about 100 days. And if we've made it this far and, the guy you walk through walking his dog every night for the last 4 weeks hasn't killed you, he's not going to kill you tomorrow. Right.
Well, there's actually, I hope nobody in my complex listens to this, but there is a person who walks her 2 dogs every night. They're the worst dogs in the whole complex. They bark at everybody. She wears a gas mask, like an actual, like World War I mustard gas mask. And sometimes I'm sitting out there like late at night and, reading my Kindle or whatever, just trying to get some fresh air. And all of a sudden I look up and it's like a horror show. I get freaked out, and then the dogs start barking. It's a whole thing. But I think the U.S. is the psyche of everyone is a little bit too gas masky right now.
We did so well on that 8x10 glossy giveaway 2 weeks ago. We should do a gas mask giveaway.
We could actually do some branded gas masks as well. Like a MyPillow sticker on it or a MeUndies.
Yeah. My latest one is the Black Rifle coffee. I've been doing a lot of Black Rifle coffee, a little bit more leaded than your regular coffee.
Seems like you had some before this podcast.
Yeah, we can tell. We can always tell.
We haven't even started talking about CRE.
No, let's talk a little bit about CMBS. Congress sent a letter to Treasury Mnuchin and Chair Powell that cited our data, actually, incidentally, asking for relief for CMBS borrowers. What might that look like?
Well, we had, I think 100 congressmen signed on to this, right? They're all looking for a Main Street bailout. We've talked about TALF before. TALF in 2008-9 was very successful. It unlocked the markets. We saw a great spread rebound rally in CMBS once the Fed started taking this as collateral. CMBS, we saw a similar reaction a few months ago in terms of spreads. AAA spreads came in really nicely 2 months ago when TALF was kind of restarted, but that's kind of a Wall Street bailout. What you're talking about right now is really congressmen asking the Fed to come up with a Main Street bailout. And if I were to guess, it's really something that would be targeted to hotel operators and to retailers in a way that puts cash in their pockets. And how you do that is very unclear. It's not the same as buying securities, which exist out there and people can pledge them and you could take them on. So they'll have to be creative. I hope they could figure out, because it would be a real shot in the arm for those two industries.
Yeah, well, I think the programs that have existed so far during COVID have been, there's been a million of them, but think about PPP, right? So that went to small businesses. So you could potentially make the case that helped some tenants in properties remain in business. But the thing about PPP is that you needed to use a certain percentage of it. I think it was 75%, and then they changed it to 60%. You needed to use that on salary because the whole point was to keep people employed. So the incentive to use that money to pay your rent was not too high. And then there was the TALF and, just the Fed quantitative easing buying securities in the market. So you were helping some small businesses, and then you were backstopping liquidity in the securities market, but nobody was helping the guy who owns, a 50-unit multifamily or that's probably a bad example. Multifamily's doing okay, but the guy who owns 3 retail strip centers who cannot make his mortgage payments due to COVID, right? So this could potentially support the fundamental driver of how CMBS performs, which is how the loans perform.
Yeah, I mean, maybe this is just me talking out loud, but the leverage point that you see on hotels and retail post the great financial crisis, right? CMBS 2.0, 3.0, CMBS risk retention, unless you have properties that have been have had mezzanine debt added onto them, right? If you're talking about a 60 or 65 LTV hotel, maybe the game is you lend to the hotel operator in return for some equity, right? You say, we will take your valuation, your LTV up to 70%. You could borrow up to 5% against the Fed balance sheet or something like that. And when you go to refinance, right, we get paid back as though we were a mezz lender, right, on a hotel or a retail property. That might be something creative that would allow borrowers right now to tap the equity value that existed in a functioning market at a time where they cannot get any value out of this property whatsoever from anybody.
Yeah. Well, and I think the thing that they'll have to figure out if they do this is, either waiving or somehow getting around the loan documents, which say a lot of the loan documents will allow for a certain amount of additional debt or no additional debt after the CMBS loan. So like you said, maybe it's a preferred equity type thing, or maybe there's some sort of sweeping industry-wide, agreement that says we're going to let them take this particular program on. It's really like a PPP for CRE owners.
Right. I don't want to put words or ideas in the Fed's mouth, but I can't see the Fed wanting to go north of like an 80 LTV, right? A preferred equity piece that represented the equity strip between 90 and 100 LTV is hard to see them putting the taxpayer at risk for that kind of thing. But if you're talking about something which takes leverage from 65 LTV to 70 or 72 or something like that, maybe something that gets, the roadside hotel operator who doesn't have mezz debt on this thing, or the strip mall operator to a point where he's not reliant on the capital markets taking him out with refinancing, or the special servicer giving him relief in terms of, reduction of loan rate or some kind of loan forgiveness or something like that.
Yeah, well, it'll be interesting. I mean, it has to have something to do with the value, and, that brings up the idea of like intrinsic value or pre-crisis value or fundamental normal market value. So I'm sure they'll use something like, when was your last appraisal, and maybe use that or whatever it is. But it's kind of what we've been talking about for weeks, right? How do you come up with the value of something right now when there's very few transactions happening?
Well, theoretically, you could say something which is, we're head cutting every value by 20%, and we'll give you, 50% of the equity between what you have now,
right,
up to that 80% value of what we last had, or something like that. But it's
so they'll get you from 60 to 70, right?
Right. So we know Fed Chair Powell listens every Friday morning. We know Mnuchin listens every Friday morning. So fellas,
yeah, give us a call. We'll help you out.
Give us a little love, man, too. If you want to call this the Clancy plan, or the McBride plan, or the Clancy McBride plan with a hyphen. And we could also throw Coacher, right?
I'm not running for office.
The CMC plan, right? We could do that.
Our team released a report showing delinquency rates and special servicing by metro areas or MSAs. Not surprisingly, lodging and retail had the highest delinquencies across the board. However, there's some interesting takeaways there.
Yeah, you do have some areas that are they were problematic before you even got to COVID, right? Houston was one of the big areas that had so much energy, space to energy and gas exploration tenants. There was a glut of space for the last 3 or 4 years. We did see a couple of newsworthy items this week that we wrote about in TreppWire. On the negative side, we saw that the 2 Westlake Park loan, an $88 million loan that backed a 2014 deal, flipped to REO this month, which is a terrible turn of events, right? The borrower has thrown in the towel. It once had huge swaths of space to Conoco and BP. Its occupancy now is 5%. So I guess not a big surprise that the owner threw in the towel, but that property is now REO. On the more positive side, there's a big single borrower deal that's backed by the Greenway Plaza property that has huge space devoted to Occidental Petroleum. I think it's more than 900,000 square feet, if I'm not mistaken. They were rumored to be leaving about a year ago, but they re-upped for 5 years, which now takes a big element of the risk off the table for that particular single asset deal. Although you always have to worry about Occidental. Will they make it in a $20 or $30 or $40 per barrel oil world?
So maybe we shouldn't spoil the delinquency report, the monthly delinquency report, but tune in to see if we break the record. The MSA breakdown that we put together was fairly interesting. I mean, these are always kind of tough to gauge, right? Because a lot of times the MSAs with really high delinquency percentages are also a little bit smaller. So maybe it's one large mall or one large office building that's causing, the rate to be so high. But just looking at things, Syracuse, Albany, Minneapolis, Portland, Cleveland, New Orleans, Tampa, Chicago, like those are very high up on the top 20 list in terms of percentage. And then, if you sort it by balance, delinquent outstanding balance, it just looks like what you would see if you sorted the whole market by balance: New York, Chicago, LA, Houston, DC, et cetera. But some of these, percentages are, New York, 7%, LA, 6%, DC, 8%, Dallas, almost 10%. So all of these markets that for the last 10 years, we've been saying our gateway city bulletproof markets are not immune, no pun intended.
Well, we've had some interesting stories come out this week about New York and Chicago, and they are things that investors want to watch in a big way because they could influence valuations of properties considerably. One that we wrote about in TreppWire, I think this morning, Thursday morning this week, high-end retailer Valentino has space at 693 Fifth Avenue, a lease that runs until 2029. The property itself backs about $240 million worth of 2016 CMBS debt spread across 4 deals. Even though Valentino only has 15% of the space, they are responsible for basically 87% of the underwritten base rent. And they have gone to court to annul their lease, basically saying that because of COVID, they can no longer support the debt service, or I should say the lease payment that they need to make for the next 9 years. And if they were to win this case, it would just open up a flood of opportunity for people to walk away from leases, really from 42nd Street up to 59th Street, from Madison Avenue over to 8th Avenue, all of Soho, all of Lower Manhattan. It's a real concern if that case is won. In Chicago, we had another case where it was determined, that case was adjudicated, although it may be appealed, where a restaurant is only responsible for 25% of their rent as a result of COVID closures. So there's a lot going on. We've seen in San Francisco bills being floated out there to make leases annullable, basically, which we talked about a couple of weeks ago, which I think that bill has failed. But in this environment, you really have to know and watch what's happening in the legal community to really have a firm grasp of what your risks are.
So this is so fluid. Things are changing every day, but I do think I saw something about Jack Dorsey and saying that, Twitter is going to go to 100% remote work over the short term. And part of that is due to the fact that San Francisco has raised the city tax on corporations like exponentially over the last few years, and the cost of living, and obviously everything else that's happening with people realizing that they can work from home. But in terms of the high street retail in Manhattan, I have I'm long a few things, right? So we've already talked about it. Toilet paper, we're very long, right? Plexiglass, long plexiglass, right? I was actually looking for this the other day, if there's some sort of plexiglass ETF or, plexiglass distributor, because everywhere you go now in every mom and pop shop, deli, big store, Home Depots, Lowe's. I mean, it's plexiglass everywhere. Plywood, right? Because if this Valentino's thing happens, then you're just going to see boarded up windows for a long time on these high street retail spaces. And fireworks.
Circus tents.
And fireworks, right? Because all my buddies who live in Manhattan and Brooklyn are posting Instagram stories every day about how there's just fireworks going off all day, every day, all night, every night. I see Keegan nodding his head in confirmation. So, there's just a lot of craziness going on. And if that Valentino's, if they win, who's to say that Victoria's Secret, Apple, all these other, who else is on Fifth Avenue? Rolex, right?
Yeah. David Yurman. Right.
You're just thinking of the places that you've gone in the past.
Oh, I love my David Yurman bracelet. But, Keegan is one of the mellowest guys you'll ever meet. And I could picture him getting home and, and it all just bubbles up all day. And then he just has to open up that window and yell at those kids, "You gosh darn kids, get off my sidewalk."
No, he's the one shooting Roman candles out his window at him.
That's exactly
and one more note to get back to reality here. Brian Stoffers mentioned it in our interview when we were talking. And now ever since, it's like, when you hear a word or you hear a term for the first time, and then after that, you always seem to hear it everywhere. It's the hub and spoke concept, right? And we've been talking about it with Trepp putting an office in White Plains and Jersey and Long Island. And there was a Commercial Observer article this week about how they're seeing increased demand on the Jersey waterfront, Hoboken, Jersey City, other places, for companies that are looking to lease space as kind of satellite offices. They also mentioned Westchester. So that suburban office play around the core of the major cities, could be something. It's literally reversing the trend that we've been talking about for a long time.
I've been hearing about this residential wave that people have been saying there's this residential price war going on of people in Westchester and northern New Jersey and central New Jersey and Long Island seeing houses getting bid up. And I don't really understand that yet, because if you're a guy who is thinking, okay, I want to move up to Westchester, but you don't know if this hub and spoke thing is going to come out, and you're not sure if that hub is going to put you out in Summit, New Jersey, like our long-term listener friend Dave, right? How would you do that? Commuting from, Scarsdale through the city all the way out to central New Jersey. I'm not a house buyer right now unless I know exactly what my firm is doing for the next 20 years.
Yeah. Well, I will say that in Westchester, I'm related to, and I know a bunch of people who are real estate agents, and especially Upper Westchester, they say it's like nothing they've seen before, honestly.
Yeah.
And I
don't get that.
I think there's probably, but honestly, there's probably a lot of people who have some certainty about their work and are just saying, I'm done with this apartment living. I'm done with not having a lawn. I have 3 kids and I've been working from home for 3 months. I need a backyard. You know what I mean?
Yeah. The certainty would be, I know that if my company moves me out to central New Jersey, I am certain I'm not staying with that company. Now that my house is out in northern Westchester.
We look at some of the other headlines this week in commercial real estate. There was a lot of other news in retail and others. Manus, if you want to rattle off, I know some of the things that we've just covered this week.
It's, we're on either end of the health spectrum in terms of our bankruptcies. On the higher end, for the healthy people, we saw GNC announced that they had gone bankrupt, the vitamin supplier, and that they're going to look to close 1,200 stores. So another slice in the death by 1,000 cuts to the mall owner as they lose more GNCs.
Another blow to the very fit, 24-hour fitness, right? Plus GNC.
Well, you got to go balance of nature now. You ever hear those ads? 100 fruits and vegetables in a little capsule, right? That's they're on the radio all the time.
We're doing a lot of free ads today.
Yes. On the other side of the spectrum, we've talked about this. This was kind of, we thought this might be coming, the sad day that Chuck E. Cheese filed for Chapter 11 this week. You know, when you go into Chuck E. Cheese, you know, they have all those, like we talked about this before, the rubber lizards and the paddle ball with the string on it, but there's always a TV there, right? If you can come up with like 40,000 tickets, you could have the TV, but if you do the math, you'd have to play skee ball for the rest of your life to get the 40,000 tickets. But all I know is my family, we probably have like 8,000 tickets here, and I don't want them to go to waste. So there'll be a Chuck E. Cheese visit in my future at some point to get a few more of those, you know, fake roaches that you stick under people's desks.
Well, did you see that there was an article a couple days ago about Simon and Brookfield potentially putting in a bid to buy JCPenney? Right. They've done that with, who'd they do that with? Aeropostale and Forever 21?
Forever 21, yeah, they did that with. On the negative side, we did see JCPenney, not that it was unexpected, 13 more store closings to add to the 154 that they originally announced. So they're about 2/3 of the way through their announcements, although they did pull a few back. Ones that they said, we're going to close, they changed their mind on. One was the West Shore Plaza in Tampa. But of the 13 JCPenney store closings, we did see a big one in the Poughkeepsie Mall, $134 million CMBS loan from 2012, of which half of that backed CMBX 6, which we've talked about in the past. And there was another store closing in California, Concord, California, for a mall that backs a single borrower deal. So a couple of the meaningful JCPenney's to close this week impacted some 2012 deals.
Additionally, Manus, you had written up a story in TreppWire about American addiction centers that filed for bankruptcy, and it had an interesting connection both to corporate CLOs and to CMBS.
Yeah, we mentioned this in our podcast last week with Andrew, that how much they intersect right now for us as a group which writes research for both the CLO market and the CMBS market. You know, two of the big things we look for every morning are who filed for Chapter 11 bankruptcy, along with, you know, who's closing stores and so forth. American Addiction filed for bankruptcy earlier this week. They are represented in the CLO market, and they're trying to figure their way out of this right now. But they also have a headquarters in Brentwood, Tennessee. They're the only tenant behind a property that collateralizes a CMBX 10 office loan. So it was one of those moments where, you know, if you're a fixed income desk that invests in both CMBS and CLOs, it was kind of a double whammy, right? It could have gotten you coming and going, that particular story. And we do see that from time to time, also in the oil and gas space.
And Trepp is going to continue its spotlight on CMBX with CMBX 9 this week. What's particular about this series?
Well, it's unique in that it has the most multifamily of any CMBX series at about 15% multifamily. So a mitigating element of that particular, which gives it a little bit more strength maybe than some others.
So talking about multifamily, last week we took a deep dive into multifamily, specifically an area that focuses on affordable housing. And there were some interesting takeaways from a webinar that we did last week.
Yeah, so a couple of things to potentially worry about, right? One is the eviction moratoria or moratory. If you're talking about one, it's moratorium. If you're talking about multiple, it's moratoria. A lot of those will be expiring over the next couple of months, at which point, you know, the owners of these multifamilies are going to have to make a hard decision on what they do with tenants who have been affected by COVID, who can't make the rent payments anymore. The other part that they kind of talked about was the fact, kind of things we know, right? Which is, in most of these urban cores, the affordability indexes have just gone so down over the last several years. I mean, down or up, however you want to say it, right? Affordability is really not there. And, some of the potential options for alleviating this, because in my opinion, it's a supply issue, right? There just is not enough supply of multifamily apartment units, and therefore demand is higher than supply. So prices go up. I think HUD Secretary Ben Carson suggested using some of these empty commercial buildings, potentially, Brian, again, Stoffers from CBRE mentioned potentially using hotels and converting those, maybe even some of these suburban offices that are struggling, although maybe they won't be struggling anytime soon. But, I just think that this affordability issue is something that was raised at CREFC, pre-COVID. And to me, the only answer is more supply. But, this is kind of one of those chicken and egg situations where in order to fix this, you need more supply. But then when you want to build more supply, the people in the neighborhood don't want their values going down, so they fight it, right? So it's kind of a vicious cycle.
I was playing golf at Dunwoody in Yonkers this week, and from the 18th tee box, you get a great view of Manhattan, and you can really see some of those big buildings that have gone up in the last 4 or 5 years, those 100-story apartments on 54th Street and 57th Street and 59th Street, which do nothing for the skyline, by the way. I think that they're kind of scars on the skyline. But, people have often said that, they're high end, right? They're $10 and $20 million apartments, but they remain 35 or 40% sold, right? There's big swaths of emptiness there. And can you imagine if that's the thing that becomes the affordable housing, right? That's the one that defaults, and all of a sudden, right, you're putting people of moderate income on the 99th floor of this building that was really meant for some
Saudi sheik or something.
Yeah. I mean, wouldn't that be a twist of fate?
Looking at banks, the Fed is releasing the results of its bank stress test this week. Last week, the FDIC reported an increase in the number of problem banks for the first time since 2011. What might we expect from the Fed results?
Well, in some ways, we've talked about this at times in the past. You throw away the old data and you throw away the old playbook because it doesn't apply anymore. The rules and the data by which the banks had to run these stress tests was made months ago, right? The unemployment rate, the 10-year treasury rate, the cut in commercial real estate values. So it's in this particular case, in this year, it's a real lagging indicator of what took place, right? The reality was much worse than the severity that they thought would have represented the severely adverse case. So if banks don't come through this cycle with kind of flying colors, it would be really shocking. I think that they do come through like they have for the last 4 or 5 years. It might give investors and banks false hope because they may not realize, unless you're deeply in the weeds of how these stress tests work, hope that, okay, we've survived the COVID period, but in fact, we haven't even addressed it yet in terms of the projections we have to make.
Well, also, thinking if it's a purely quantitative exercise, which it's not, I mean, there's a qualitative portion to it, but a lot of it is quantitative. The banks were probably all going to pass and be fine anyway, but the Fed is probably fairly hesitant to come out and say, hey, this big bank just failed the stress test in the middle of this pandemic crisis, right? I don't think the Fed wants to throw any gasoline on the fire right now. So I'd be very, very surprised if there were any surprises in the results, right? But I agree, Manus, we've said it many times, the severely adverse scenario for the last 5 years, every client we've ever spoken to who's first laid eyes on the severely adverse scenario would say, that's insane. That's crazy. That's a break the bank scenario, and look at us now. right? Where we don't know what the Siri price index really is right now because we don't know where values are, but we know where unemployment rate is, right? It's well above what the severely adverse would have said. We know where we'll see where house price index is and things like that. But the thing about the stress tests that they don't include is the too big to fail concept, right? Which is, if there is a severely, severely, severely adverse case, the Fed will swoop in and lend me a bunch of money to keep me alive, and that's not something that's kind of built into those models.
Right.
Trepp has its own stress testing model. How will it compare, do you think, to what the Fed results are?
Well, in the past, we've really tethered quite well. Our predictions are really very close for all three scenarios, for the baseline, the adverse, and the severely adverse over the course of the last 5 years. We've been really kind of right on top of where those numbers have come in. The beauty of the way our model team has built, headed by Matt Anderson in our organization, is that you could put in whatever assumptions you want for these stress tests. So just because the Fed has dictated that these are the three scenarios that you must run, in our system, which is commercially available, somebody could put in an unemployment rate of 20% or a GDP of negative 10%, a negative treasury rate, for instance, and run their stress tests and see what a break the bank scenario would look like. Unfortunately, every now and then we do get people trying to use it and they mistakenly put in only one variable changing. They'll say, let's put in a 40% unemployment rate without necessarily changing GDP to negative 30% and treasuries negative and other things. But when used properly, it can really come up with a nice break the bank scenario for people. That would be me, by the way, the person that puts in changing only one variable. I'm not trying to disparage any of our users other than me.
We do now and then, not naming any names, get that question of, well, why the model doesn't make any sense? We changed, we changed Siri price index to drop by 50%, and it's not having the effect it's because unemployment's still at 3% in your model. But anyway, moving away from the nerd stuff, the one other kind of bank specific item we published this week was a report on our Taller database, which is our consortium of banks that provide us with quarterly loan performance data, loan level data. And through the first quarter of 2020, we saw, I think it was 3 straight quarters of construction loan delinquency increases, right? So I think that first quarter data, if we remember, it's hard to even remember, right? Because it feels like we've been in our basements for 10 years, but it was kind of mid-March when this thing really started to take hold and when people started staying home. I think it was like March 15th or something like that was my last day, kind of taking the train home. But I don't think that the effects of this have really been felt in this particular data set. So it's interesting that it was already increasing, and it would, I would expect a much higher increase next quarter when we get the data.
Turning to corporate CLOs, the Wall Street Journal this week had a good overview, or primer, as we've debated how you pronounce that word before, on CLOs, also citing some of our data that showed how CLOs are structured and why they're so crucial in the market. What was the key takeaway?
I think the key takeaway is, it's a lubricant to our economy, right? That the CLO market has become the vehicle by which double B, single B, triple B credits get their cash, right? And without that, where do these small, private, off the beaten path or unloved industries get their cash, right? It's always very easy for the Apples and the Facebooks and the would-be next unicorns to come up with equity valuations from private equity and other vehicles. But for the guy who's running a movie theater chain, casual dining, airlines, as we've seen, who are unloved, oil and gas and so forth, they tap this market frequently. And if this market were to seize up, as it could, right, if CLO buyers fade away, it would just be more friction in an economy that really can't afford to have much more friction.
Yeah, I think one of the other parts of it or concepts was that CLOs tend to perform fairly well even during downturns, and that they did. I mean, let's be clear, there are CDOs and there were CLOs, and we're talking about CLOs, and their structural makeup and the way that their waterfalls are created are meant to protect the AAA holders. And they have performed very well because they diversify across industries, and they have rules about interest diversions and all those types of things, and over collateralization tests. But the thesis this time is that during the great financial crisis, it was really financials that got killed, right? So the financial sector got really hurt. Big banks, mortgage lenders, things like that. Whereas this time around, it's kind of widespread, right? So there are a lot of industries that are getting hurt. So the diversification benefit, kind of goes away a little bit. So, as correlation increases across the industries, the benefits of the CLO or the protection of the CLO decrease, right? But I do like what you mentioned, man, is the lubricant. I mean, when I teach my class, when we talk about securitization, I really make that point of we are connecting capital suppliers with the needers, with the people who have capital deficiency, and we are doing it in a much more efficient way than, hey, 1,000 people put their $500 in a savings account, and then the bank goes out and lends money to its neighbors, right? It's just a much larger, more efficient, faster, more liquid market for debt.
I never thought of it this way, but what you're saying is we're doing God's work.
Yeah, basically.
I'm
not trying to sound like a master of the universe, like Bonfire the Vanity style.
I'm not sure
No,
about that.
I was.
I'm just the shoe shine guy. I'm the shoe shine guy in Bonfire.
We have some good followers that are sending very kind inbound emails lately. So I don't know, maybe you have a cult following. It seems masks, by the way, are mandatory in Vegas after the casinos and restaurants reopened about 4 weeks ago. So with the new policy, what do you think? Will that help or hurt the tourist flow?
It won't matter. Did you see the video of the guy at the slot machine? He had a mask on, and he was putting a cigarette in the side and smoking the cigarette sideways through his mask. That is American ingenuity at its best. And that is why we will come back, and that I do believe that wearing masks is probably a good thing if you're indoors. But as long as you're bringing your cash to the table, right? And as long as I don't know how they're rolling the dice, though. I don't know if they're like replacing the dice every time it gets rolled or whatever. But, people are dying to get out of the house. People are dying to go do things, right? So if I have to wear a mask to go and do things that I used to do, I'll do it, right? And I think that's true for most people.
Well, maybe you should take the L-shaped cigarette idea onto Shark Tank.
It's more of a bathtub shape.
Right. What I'm looking forward to, and this is just me wanting to kind of see what life is really like, once we get to phase 3. I think de Blasio was saying this week we're going to go to phase 3, which means one of these days they're going to start opening malls up in New York and New Jersey and so forth. And, I would like to take a road trip. If I really had my druthers, I would take my Dodge Durango and I'd take one of those things and put it on the side like we look like a radio station. And it would say like, Joe, Martha, and Manis in the morning, right, with the podcast, and people would know the mobile unit is out. And I would take it to the Short Hills Mall just to get the vibe. Like I'd want to set up a table and start interviewing people to see, what are you buying? Are you going into the Nordstroms, the Neiman Marcus, the JCPenney? And I'd want to support the cause, of course. Like you want to help. Although Katie McGee might never talk to me again, but I would be so torn. I'm a frugal guy. Martha knows I'm a frugal guy. If I can get 3 machine washable suits for $90, I'm happy. Right? That's my vibe. But I do feel like I should dig a little deeper in this environment and get, 2 machine washable suits for $90, right? Just pay a little bit more than usual and help the economy, get these guys, off the mat.
Well, I think that kind of road trip is in our budget, so I think we can make it happen.
All right.
And with that, we'll close. Thanks to our producer, Keegan St. Ange. May join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. And until then, visit trepp.com for more info and subscribe to the podcast via your favorite provider. Thanks for listening and stay well.
All right.